Thank you for inviting me here. Thanks to everyone who's part of the FANG. I really appreciate the opportunity to present a subject that's near and dear to my heart, which is charitable giving, and in this case, in the context of a business exit plan and how that might fit into the business owner's goals, personal, financial, philanthropic goals. My talk is called Exit Planning for Business Owners, Incorporating Charitable Giving in a Succession Strategy, and also beyond. I got a couple of other ideas as well to share with you all. And as Mark said, I'm Juan Ross. I'm a partner with Forum Financial Management. Forum is a national independent registered investment advisory firm, offices in, I think we're up to 15 or 16 states. And we have an office that I operate out of here in Scottsdale, Arizona. And I also am part of the Thousand Oaks, California team as well. So I shuttle back and forth once a month on that. But let's get into the discussion and the topic, and feel free to ask questions. And I know that Mark will be moderating the Q&A and interrupting me as needed. But while we get started here, first I'm going to lay some kind of a foundation for the discussion today. And today is the first part is about the what. What are we talking about? Why are we talking about it? If you think about charitable giving as a whole in the United States, the most recent data, which is from last year, $557 billion was donated to charity. Now, it might come as a surprise to some that individuals make up the largest, by far, the largest block of givers to charity. 2/3, roughly, is given by individuals. And if you look at this little slice that says bequests over here, those are also individuals who just happen to have passed away. So if you add that together, you're almost at 75% of all giving is done by individuals, within a slice going from foundations. And people think that corporations tend to give a lot of money. They don't really give all that much. In fact, they give the least of all of the different representatives here from the giving circle. So individuals give the most out of anyone else. Who do they give to? Well, here's kind of a representation. This is also from 2023 data. And religious organizations by far get the most amount of charitable dollars, about $145 billion last year, followed by human services, education, public society benefit organizations, and health, and then a few others. But the slice that religion has been number one for a long time, but their share is actually, as a percentage, has started to come down in recent years, but still way out in front. So that's kind of a basic kind of background about charitable giving in general. But let's talk about the why now. And I'm talking about the why from the perspective of the business owner and all donors in particular. But we're here talking specifically about business owners. The reasons that people give, the number one reason by far is their personal values or beliefs. People are just very generous. And that's always that, or a version of that has been the top reason why people give for as long as research has been done on this particular topic of philanthropy. Interest in the issue area is a close second. Then that fact that it's a recognizable nonprofit is another one in the top five. A perceived need of the organization or of that particular issue, or you or someone you know benefited from the services of the organization. And we're talking usually healthcare, hospital, or some kind of relief organization. And so those are the top five reasons why people give. You'll notice what's not on this list is taxes. Taxes is never one of the top reasons why people give. It's always kind of way down below. It is a great side benefit, and it's what we're going to be kind of focusing on in my talk today, but it's not really a primary motivation for giving in general. And, you know, giving has continued to evolve over the years. It's not just people writing checks to organizations anymore. It's all about online giving. There's the Giving Pledge, which Bill Gates and Warren Buffett were the first ones to start this Giving Pledge, and now a lot of other billionaires have signed on to it, that they're going to give away most of their wealth to charity. Donor advised funds have become a huge giving vehicle. We'll talk about those in a little bit. There's also crowdfunding, and Gen Z, are they really into impact investing? Like, what is the actual impact of dollars? And then there's also this new thing called charitable LLCs. And Mark Zuckerberg was kind of the one who kind of made those a huge thing when he created his with a bunch of Facebook stock. So there's all these different tools and trends when it comes to giving. And one thing that's important for this group in particular to know is that business owners, they are charitable as well. The median annual gift is 50% higher for business owners than it is for non-entrepreneurs. Almost 80% of business owners will say that charitable giving is a critical part of who they are. This comes from a Fidelity Charitable Survey. 73% have had a conversation with an advisor about giving. 69% want to incorporate giving into their exit plan. That's a huge number. And about 2/3 volunteer 2 or more hours per month. So business owners are very charitable. The problem is there's some obstacles in kind of fulfilling that charitable piece of themselves. They may say something like, I'm torn between donating to charity and holding on to money for personal needs. Or they may be too disorganized to keep track of their charitable giving. Or they may feel compelled to give to causes when asked by friends and family, and it may not be something they always want to have to say yes to. Or they just don't know who to turn to for advice on what to give, how much to give. So, these are kind of the things that may be bubbling up underneath, either consciously or subconsciously, in the minds of the business owners, your clients. Well, the solution is simple. It's to put together some kind of a charitable giving plan. This is something that I help clients with, my business owner clients. First of all, really distilling their motivations for giving. What is their primary, what is deep down in their hearts, the reason why they want to give? Maybe even developing what's called a personal giving statement, something in writing that lays out their motivations. That's like their own personal mission statement. Then it's about identifying what asset will be given away. And there's a lot of different reasons to select different assets based on what's on their balance sheet. Which vehicles from the charitable side will be used? What are the tools that are available to donors to make their giving the most efficient from a tax standpoint and in terms of accomplishing their goals? And then, of course, eventually choosing which charities to support. So all of that is part and parcel with a complete charitable giving plan, which is a component of a client's overall financial plan. And something that maybe those of us who deal with numbers on a day-to-day basis may not always talk to their clients about, may not always be comfortable talking to their clients about, but it's really important in this context, is to start with legacy or philanthropic goals, not necessarily with the tax benefits. So here are some questions that you can ask a business owner to kind of start getting them talking about this area of their life. Are you actively involved in any nonprofits? How do you decide which organizations to support? What's that decision-making like? And do you typically support the same organization every year? Do you change? Who is involved in the decisions about where and how much to give? Is it you and your spouse? Are the children involved? Is there somebody else? Do you prefer to give during your lifetime or at death? And the answer to that will drive the specific strategy to be used. And it could be both as well. In your estate plan, have you named any charities to which you will leave money? That's a key indicator there. Do you prefer to give anonymously or publicly? There's ways to do that as well. How do you make your donations? Do you just give cash, which, by the way, is the least tax efficient asset to give? Stock, something else, real estate. We're going to talk about business interests shortly. And do you have any charitable vehicles currently in place now? So these are just kind of open-ended discovery type questions to help distill the client's motivations, the business owner's motivations in this area. Okay, so with that as the introduction, now we'll get to the how. And this is really kind of where the rubber meets the road in this area of incorporating charitable giving into a business exit plan. The first thing you want to know, and this part of the discussion is broken down into 3 critical considerations. These are the 3, I would say, maybe decision points that, depending on which way you go, will influence what the eventual strategy is, how it's implemented, and other things like that. The 3 critical considerations are the timing of the gift. Number 2, what is being donated and to whom? And number 3, the business entity structure itself is a really key consideration when it comes to charitable giving. In addition to those 3 considerations, there are a couple of other things that need to be remembered, kind of critical to this whole process. That's the appraisal requirements, which I'll get into what those are. You have to have very good documentation, usually means involving an attorney to look over agreements and things of that nature, and coordination across the entire advisory team. This isn't done in a vacuum or in a silo. you need usually the estate attorney, the business transaction attorney, you need the CPA, you need the fractional CFO, key employees in the business, possibly, depending on what's being given away. So it's a multidisciplinary process. And I really espouse and honor that. Okay, so the three must-haves that a business owner needs to have these three things in order for this to work. One is charitable intent, or openness to a charitable strategy. If there is no charitable intent, if on a scale of 0 or 1 to 10, the charitable intent is 1, meaning nothing, never want to give any money away to charity, this is never going to work. Not even if you explain the tax benefits, forget about it. There has to be some openness, because there is a trade-off. In all of these strategies that I'll be sharing with you, the donor, the client, has to give something up in order to get the benefit that they want. They could be giving up ownership of an asset, either permanently or temporarily, control of an asset. There's all these different things that come into play that if there is no charitable intent, the client will not see the benefit because of that trade-off. Number 2 is that the gift, if it is to be a gift before an exit, before a transaction, it has to be made before the donor is under any legal obligation to sell the asset. And I'll get into that a little bit later. That's the prearranged sale. And then there has to be some kind of evaluation, especially if it's a business interest, an illiquid business interest. The evaluation piece that goes hand in hand with what I mentioned in the prior slide about having a qualified appraisal. And IRS publication 561 lays out the details of what defines a qualified appraisal done by a qualified appraiser. Very specific requirements for the appraisal, very specific requirements for the appraiser. So these are things that we got to make sure that we get really buttoned up. A few other considerations in terms of exit planning and charitable giving: marketability of what's being donated. That could either cause problems or be a good thing. Any restrictions, either in the shareholder or the operating agreements to transferring business interest to charity, and if there's any debt in the business, that could, in some cases, present a problem. So I'm gonna go over all this kind of at a high level, and then we'll see what questions y'all have. But going back to the 3 considerations, let's go to the first one, which is the timing of the gift. Okay, so we can either make a gift pre-sale or post-sale. That's it. That's your decision, your inflection point. So let's talk about pre-sale options. You tend to have more flexibility in designing what you want if you plan this ahead of time before the sale, but it does add a measure of complexity to the strategy just because of the various rules involved. So the entity type, as I mentioned earlier, it plays a huge role in what you can do before a sale. And we'll talk about entity type. It's the third of the 3 considerations. So we'll get into more specifics in that shortly. But what is being donated also plays a role. That's the second consideration. Are we donating stock or LLC interest, or are we donating assets, corporate assets? Timing is critical here. As I mentioned earlier, no prearranged sale. If you have any legal obligation to sell, that this gifting strategy will be deemed prearranged sale, and the tax benefits go away. So we'll talk about that a little bit more shortly. But basically, pre-sale, you have 3 primary giving options. You have a charitable remainder trust, could be one strategy. A charitable lead trust is a second strategy, and just an outright gift. Generally using a donor advised fund is the third strategy. And that would be kind of like a gift and sale, where you make the gift and then the sale happens with the donor advised fund. So in case you're not familiar with these strategies, let me just do a quick 101 on each of them. The charitable remainder trust, that is the Swiss Army knife of gifting strategies. It can do so much. It is super flexible. There are some pitfalls you want to watch out for, but it's a really great strategy. So in a charitable remainder trust, the donor gives property into a trust that has been already drafted by an attorney that meets the qualifications under the IRS code for a charitable remainder trust. Once that happens, the donor then gets several benefits. They get a tax deduction, not a full fair market value tax deduction, but somewhat reduced, because they're getting a benefit, and that is income out of the trust. So for example, investment real estate, for a client who is all done with investment real estate. They don't want to be a landlord anymore. They don't want a 1031 exchange anymore. They just want out. This is a great exit strategy, a charitable remainder trust for that kind of asset, because then they get income out of the trust for life, or it could be for a term of years, or it could be life plus a term of years. There's different flexibility with that. And then whatever's left over at the end of the term of the trust goes to charity. Okay, that's how a charitable remainder trust works. It's called remainder because the charity gets the remainder at the end, while the donor is getting income all throughout the life of the trust. The charitable lead trust is the flip of that. It is the reverse or mirror image of that. It is very underutilized. It comes with some complication, but it is mostly used for income or gift and estate tax leverage. Really powerful with gift and estate tax leverage. It was even more powerful when interest rates were near zero. This was huge because the way that that leverage is calculated, lower interest rates favor it, but it's still very good even with today's interest rates. The way this works is the donor transfers property to the lead trust, properly drafted by an attorney, meets the qualifications of a charitable lead trust. And during the life of the trust, charity gets an income stream. It could be yearly. Mostly, generally speaking, those are yearly payments to charity. The charity can change. The trustee can retain the right to change the charity during the lifetime of the trust. That's totally fine. And then what's left over after that period goes to family. So that's the gift and estate tax version of this. There's an income tax version where what's left over goes back to the donor, but I'm illustrating here in this flow chart that the remainder goes to family. So it's called the lead trust because the charity gets the lead income first, and then what's left over goes back to the donor's family. Here's an example of a really advanced charitable lead trust. This is called a double discount lead trust. Now, why is it called that? Because we're assuming a family limited partnership that's worth $50 million. On paper, it's worth $50 million, but because it is a family limited partnership, it gets, in this example, a 25% valuation discount. So what goes into the lead trust is not $50 million worth of assets, but $37.5 million worth of assets. And let's say this trust goes for a period of 20 years, and each year in those 20 years, that trust is paying 6.67% to charity each year, right? And then at the end of that, whatever's left over, which will be these assets, grown over a period of 20 years, goes to family. In this case, there's some assumption of $51 million. But so this is a way to use not only the leverage of the lead trust, but a leverage of a family limited partnership to move assets out of the estate into the next generation. So really, really powerful type of a tool. The third, which is the outright gift. Usually a donor advised fund is used for just an outright gift to charity. And in a donor advised fund, the donor advised fund sits in the middle. The donor gives cash. It could be appreciated securities. It could be real estate. It could be illiquid assets like business interests into the donor advised fund. The donor gets an immediate charitable deduction for making that gift into the donor advised fund. And they can recommend grants to charity in the future. In other words, the donor advised fund it is a charity itself. It is a 501c3, the donor advised fund, but it is also, its purpose is to be a repository for funds that will be used in the future to make grants to the end charity, which could be a church, it could be the Red Cross, it could be the Humane Society, whatever. Grants are recommended to charities later, and so the original donor retains the right to recommend grants out of their fund to charities. And it can be structured for family participation. For example, you can include children in this. It's a really nice tool to pass down values to the next generation when it comes to charitable giving. All right, so those are the three main giving tools that we'll be talking about. So that was pre-sale. Now, what about post-sale options? We're going back to timing. Post-sale, it's much less complicated than pre-sale, but because the transition's already happened, the liquidity event's taken place, there's less opportunity for planning. You have what you have, and that's it. So in this case, for a post-sale, you can have an outright gift of cash. If you got cash from a liquidity event, you can use that cash to do charitable remainder trust, a lead trust, a donor advised fund, anything like that. If it's like an IPO and you're left with appreciated securities, that could be an asset that can be given away. You want to make sure you look at lockup periods and any other restrictions, things like that, things of that nature. The charitable lead trust has, as I mentioned, two flavors of the lead trust. If it's designed as a grantor trust, that's an income tax deduction type of a strategy. If it's a non-grantor, that's the gift and estate tax where it goes to the next generation. Either of those works depending on the situation. And then the charitable remainder trust, usually better funded with appreciated securities versus cash, but cash can be used as well if that's what you've got. So those are kind of your post-sale options when it comes to charitable giving. So going back to the three considerations, the second one is what is being donated and to whom, okay? And so the what is being donated, you've got corporate assets versus corporate stock or LLC interest, if we're talking about LLC. And to whom are we talking about, a public charity or a private foundation? So let's break those down. Corporate assets versus stock interests. Generally you don't really see a lot of gifts of corporate assets. I'm going to give you one example in a little bit, but it usually doesn't, the numbers don't usually pencil out really well for that. So a closely held stock or LLC or LP interests, those are more common as assets for giving. And then we'll more on that later in terms of the how the entity type plays a role in that as well. But those are basically your two options there. And then to whom, you've got public charity or private foundation. Now, the primary difference between the two is the limitation that is placed on how much of a charitable deduction you can absorb in the year of the gift. The public charity, you have a much larger limitation. It's always based on adjusted gross income, AGI. But the public charity, it can be up to 60% of AGI is the charitable deduction that can be used in that year. And that's if it's a gift of cash. If it's a gift of cash and or securities, then it's 50% of AGI. If you're talking about a gift of appreciated securities, up to 30% of AGI. There's a couple of exceptions there in the footnotes. But a private foundation is much more limited in terms of the deduction that you get, up to 30 or 20% of AGI, depending on if it's cash or security. So the public charity, you can absorb a lot more of that charitable deduction. If you are eligible for a big charitable deduction, you can absorb a lot more of it on your return if it's a public charity, which includes donor advised funds. Those are also public charities. And remember that any unused charitable deduction can be carried forward for up to 5 additional years. So you have the year of gift plus 5 more, total of 6, in which to use up a charitable deduction. But again, taxes aren't the primary reason why people give. So I have a client who made a gift into a charitable remainder trust. There was no way he could use up his charitable deduction over 6 years. He had so much income and he would use some of it and he didn't care. He's like, you know what, that's fine. I'll get what I get. And the rest doesn't matter. So it's not always a consideration. A couple of other differences between a donor advised fund, which remember is a public charity under the code, and the private foundation is donor advised funds give you privacy, whereas the private foundation does not. The private foundation has public information returns that get filed, and so those can be looked up on the internet. Donor advised funds typically no startup costs at all, whereas a private foundation does have startup costs and ongoing annual costs as well. There's no minimum payout requirement on the donor advised fund, whereas the private foundation is 5% per year. I already talked about ongoing compliance for both, and excise taxes, nothing on the donor advised fund side, 1.39% on the private foundation side. So unless a business owner there's only a couple of reasons why I would recommend a private foundation over a donor advised fund. The business owner either wants to do something with their kids, like pay their kids a salary through the private foundation as board members or as directors or something like that. That's doable. Or they have very specific grant making that may be, I don't know, something atypical that maybe a donor advised fund cannot accommodate. Or they actually want to run programs out of their private foundation, like have staff and have programs. Okay, those are valid reasons. Otherwise, a donor advised fund will win 99 times out of 100. Okay. So going back to the third of the 3 considerations. All right, so we talked about the timing of the gift. We talked about what is being donated to whom, and now the business entity structure and how that comes into play. So we'll talk about the 3 big ones, a C Corp, S Corp, and LLC/LP. The C Corp is the least complex when it comes to charitable giving. It is the easiest. If we could have C Corps all day long, that'd make life so easy for people like me and the attorneys and other CPAs who do this kind of work. For example, you could transfer all or some of your closely held C Corp stock to a charitable remainder trust. No problem there. You do want to watch for that prearranged sale. So you don't want to do it after there's a binding agreement. Letter of intent, okay. Binding legal agreement, not okay. So watch for that prearranged sale. And you probably want to use a third-party trustee rather than the donor themselves first initially until the closely held stock is redeemed. But those are easy. Obstacles to overcome. The S Corp is a little bit more challenging when it comes to charitable giving. So here's some of the challenges. If you give S Corp stock to charity, first of all, your charitable deduction is reduced if there's any ordinary income element to the S Corp. Well, how many S Corps don't have ordinary income element? Pretty much all of them do. So that reduces the charitable deduction. The receiving charity is subject to something called unrelated business income tax, UBTI, which they are probably not likely to want to pay. There's marketability issues with the stock. There's timing issues of usual pre-arranged sale issues. So it's not a great situation. How about S Corp stock to not a charity, but to a charitable remainder trust? Well, that causes the S Corp to lose its S Corp election and be reclassified as a C Corp, which may not be an outcome that the owner wants. So that's usually off the table as well. What about S Corp assets? Not the stock, but the assets to the remainder trust. Well, here again, you have potential unrelated business income issues. You have potential self-dealing issues under the IRS code. It's really not great. Are there solutions? Yes. Are they easy? Not really. Possible solutions, well, converting the S Corp back to a C Corp or to a C Corp if it was an S Corp to begin with, and then you can donate the C Corp shares. Yay, that's great. We can do that all day long. You can use the grantor flavor of the charitable lead trust, which is the income tax strategy one. They are a permissible S Corp shareholder, so that's one possible solution. You could negotiate with the charity, knowing that the charity is going to have to pay the UBTI or UBIT. Some larger donor advised funds might be willing to pay it if they know they're only going to hold the stock for a little while and then it gets redeemed. They might be willing to pay the tax on that if it's worth it to them. For example, I know Fidelity Charitable, which is one of the largest donor advised funds, they would generally pay the unrelated business income tax from the proceeds of the sale. So that's how they get around that. So basically, with an S Corp, you want to stick to making the gift post-sale. After there's none of these issues, especially if you're using a charitable remainder trust. How about LLCs? Any easier? Not really. LLCs are also challenging within this area because if you gift an LLC interest to a charity and the charity is an LLC member, hey, unrelated business income tax on an active trade or business. That again. If the charitable remainder trust is an LLC member, they have an excise tax on the LLC income. How much excise tax? 100% tax on unrelated business income. Yay, that's no fun. So the preferred is that the LLC where the interest is being donated is not conducting an active trade or business. You also want to watch for debt inside the LLC because that's bad for the charitable remainder trust as well. So a lot of obstacles here. I know I'm throwing a lot at you, but these are just want to make you aware of the pitfalls. Can you get around it? Yes, again, as with the S Corp, it's not the cleanest or easiest, but you could do a lease strategy. So let's say you lease the assets of the LLC to a third party, and that third party has to be, under the code, a non-disqualified person. So it's usually not the donor themselves or someone they're related to who would be disqualified. So this would be a non-disqualified person prior to making the contribution. Then, if you contribute the LLC assets and the only income flowing through the LLC is that lease income, that's okay. No unrelated business income tax. So that's a possibility there. And then you have the buyer waiting in the wings. So to get around the prearranged sale, if the timing between the contribution and the sale is short, then the unrelated business income tax would be rather small. So if you can keep that window short, but you want to watch out for those prearranged sales, assets that are sold to an unrelated party avoid self-dealing issues. I mentioned self-dealing issues. So there's a couple of buyer in the wings potential solutions for LLC interests. It's not the cleanest, not the easiest, but it's possible. So here are some giving pitfalls, just in general now. I mentioned the qualified appraisal. I can't stress this enough. These valuation rules will kill you if you do not follow them. Not literally kill you, but they will kill the deduction. Qualified appraisal required for gifts of more than $5,000. You can look at the code section 170. You need to actually attach the appraisal if it's a gift of greater than $500,000. It has to get attached to the tax return. Otherwise, you just have to, if it's between 5,000 and 500, you just keep it on file in case you get audited, and then they're going to want to see it. Completed and signed by a qualified appraiser, and that is defined in the code who those people can be. It's not, can't just be your friend who appraises, if you have, if they appraise something different than what you're giving away, that's usually not going to work. The appraisal has to be completed no earlier than 60 days before the date of the gift, and the appraisal has to be in the hands of the taxpayer by the due date of the return, but you do have including extension, so you have until October 15th of the year in which the return is being filed. There have been some pretty big tax court decisions handed down for not meeting these appraisal rules. The deduction has been disallowed. You can look them up. There's a whole bunch of them. They don't follow these rules. The tax court said, sorry, it's very clear in the code what you're supposed to do. You didn't do it, you're out. There's also been a case where someone not only had a bad appraisal, they didn't follow the rules, but they misstated the valuation of the asset, and they had a penalty of 40%. It's called the gross valuation misstatement penalty. So it can really cost you if you don't follow these appraisal rules. All right, enough said on that. There's also something called the contemporaneous written acknowledgement, or CWA, which is kind of like CYA, but in this case, it happens to be CWA. That's a gift letter. It's required for any gifts of $250 or more, again, under our section code 170. It has to state whether goods or services were received. Those are the magic words. If you do not have that on your CWA, it is not a true CWA, and you could run into trouble if you get audited. For a gift that's made to a donor advised fund, and most donor advised funds are really good with this, the letter has to state that the donor advised fund has exclusive legal control over the assets contributed. You don't have those assets anymore as the donor. You have given them away to the donor advised fund. Even though you retain grant-making rights to give to charity, that money's not yours anymore. And the CWA has to be received by the due date of the return, including extensions. There have been tax court decisions, you can look them up, for not meeting the contemporaneous written acknowledgement requirement. By not having those magic words, no goods or services received, any of these other things, deduction disallowed, boom, you're done. It's really not a good position to be in. So please watch out for these. The prearranged sale, we've talked about this. I don't need to go into this in much more detail, but if the sale of a privately held business is anticipated, it must still be in the negotiation stage at the point the charitable gift is made. It must not be at the point at which the IRS would deem it a prearranged sale. Again, letter of intent, okay. Binding sale agreement, you're too far gone and you can't do it. Because if it is a prearranged sale, the IRS will deem the charitable gift as anticipatory assignment of income. The result being your client, the donor, pays the capital gains tax they were trying to defer or avoid. So please watch out for that. A couple of quick case studies here. This one I call the charitable bailout. So we'll say that a C Corp owner gives stock to charity, just gives it out. And then the corporation redeems that stock using retained cash on the books of the corp. So the gift and the redemption are income tax-free transactions. The donor gets a deduction at the fair market value if the stock was held for more than a year, which C Corp owner probably held for more than a year. And on the corporate side, you don't get accumulated earnings tax because you're using retained cash to redeem the stock. So this is actually a pretty good a good outcome here. Again, watch for a prearranged sale if that's anticipated. It can be used in succession planning, something like this, if the children are the stockholders prior to the redemption. So this is a pretty good potential scenario here. Another one using a charitable remainder trust is what I call unit trust and redemption. So similar, the C Corp owner gives stock to the charitable remainder trust. The owner receives charitable tax deduction. The charitable trust sells the stock tax-free, gets redeemed by the company. And after the redemption, the owner receives income from the charitable trust, because that's the whole reason for setting up a charitable trust, is you get that income stream. Some considerations in this particular scenario. The redemption by the corporation must be at fair market value. No, you can't go discounting this. It has to be at fair market value. And the company must offer to repurchase all of its stock subject to the same terms, so that every shareholder has the opportunity to sell shares back to the corp under the same price and terms as what's in the charitable remainder trust. Now, if the other shareholder, if there are only a couple other shareholders, if they happen to be family members, they should all be kind of aware of the strategy here so that they're not going to try and sell their shares back to the company at the time this redemption offer is made. But that is under the code what has to happen. And a little time has to pass between the donation to the charitable remainder trust and the redemption of those shares. You can't cut it too close there. The company has to use actual cash and not a note to repurchase those shares. Okay, so there you go with the unit trust and redemption. Here's an S Corp example. So this is an asset sale. So because we know that S Corp shares are very problematic, as I mentioned earlier, the S Corp donates assets to charity. Okay, the S Corp receives a charitable deduction, and that flows through to the shareholders. Okay, not a bad thing. A couple things to remember about that. One, the S Corp shareholder, as you all probably all know, can only take the deduction to the extent of their basis in the shares. So if the deduction is larger than their basis, there's some unused deduction there. They just lose it, which again may not be, that may be okay with them. When the S Corp donates assets to charity, there's possible unrelated business income issue, that pesky UBI again. This can be avoided by that leasing strategy I mentioned earlier, leasing assets to a third party prior to contribution, converting that active income into passive income. You don't have a UBI issue. And the S Corp has to contribute less than substantially all of its assets to charity. You can't just give all your assets to charity. It has to be something less than substantially all of its assets to avoid immediate recognition of gain. Okay, I'm going to close with a couple of other non-charitable strategies for business owners. These are just my two top favorites that I like to talk about. Cash balance plans. Again, this is not charitable, but if you don't use cash balance plans, you are missing out on a huge opportunity for significant tax deferral for your business owner clients. The contribution amounts that they can contribute. A cash balance plan is a type of a defined benefit plan that usually goes hand in hand with a 401k profit sharing plan. Sits above it. They kind of work in conjunction with each other, but you can get the significant tax deferral, flexible contribution amounts each year. You do need the owner to have a kind of a commitment over a number of years and some good cash flow to be able to fund this thing over a number of years. The contributions can get larger as the owners approach retirement age. And again, it's paired with usually with a safe harbor or a profit sharing 401k plan. Love cash balance plans. They're awesome. The other is Section 1202 qualified small business stock. So if you're not familiar with this, you can exclude gains up to the greater of $10 million or 10 times the adjusted basis from federal tax. This is huge, but it is, not every business will qualify for this exclusion of gain. And if both spouses own shares, it increases the limit to 20 million. I mean, it's great. Children could also own small business stock through a trust, and there's gifting opportunities there. It has to be a C Corp, though, a domestic C Corp. The date of issue and immediately after, the company gross assets have to be less than $50 million to be a qualified small business. The owner must hold the shares for over 5 years. They must purchase or receive the shares directly from the company, and the company does not purchase any stock from individual 2 years before and 2 years after issuance. These are all the requirements for qualified small business stock. And if the stock was issued after September 28th of 2010, is a 100% exclusion of gain. Otherwise, if it's older stock, there's different gain exclusion percentages, 75% and 50%. State rules may differ, so just be aware of that. Corporate actions like reorganizations or significant redemptions, they may impact the qualified small business stock exclusion. You can't have an offsetting short position. Hardly see that, but that's just a rule. And stocks purchased through incentive stock options and non-qualified stock options may also qualify for this gain. So really huge Section 1202. Love Section 1202 when it comes available. So key takeaways, and then I'll close here. At each of these 3 decision points, timing of the gift, what is being donated and why, and the business entity structure, there are multiple considerations and there are many potential pitfalls. So please be aware. The business owner needs a strong advisory team, well-versed in the nuances, all this arcana of charitable giving rules that I've just really fleshed out in broad strokes today. And finally, it all comes down to intent, goals, and objectives. What is the business owner trying to accomplish at the end of the day? And with that, I want to say thank you very much for your time and attention. My contact information is here. I guess the slides will be given out. Please look at these disclosure slides, and my compliance office will be very happy that I shared them with you. And we'll stop there.